Hi, I'm Jessica Rabe, one of the co-founders of DataTrek Research. Today we're going to address the long-running debate of whether you should own stocks or gold, but with a twist by comparing just US large-cap tech stocks and gold. One or the other looks like the smarter investment during different times, but ultimately we like both. Before I explain why, let me briefly discuss our thinking behind this comparison. Gold is a static store of dollar-based value. Its uses have stayed the same for thousands of years, including everything from jewelry to monetary-based applications. As for tech stocks, we'll use the NASDAQ 100, also known as the Qs, as our proxy. To us, the NASDAQ 100 represents the economic value of human innovation with its holdings of big tech and high-quality growth names. Their equity values are rooted in both their usually very profitable business models and how they can improve their offerings over time by developing and commercializing disruptive technologies. As for how gold and the NASDAQ 100 trade versus one another, here's a one-year trailing relative price returns between the Qs and gold using the GLD ETF since 2006. And as an aside, there's no magic behind that date. It's just the first full year of relative returns we could run since GLD came out at the end of 2004, and we're comfortable that it's a long enough time frame to provide a useful comparison. For reference, when the blue line is above or below the x-axis, the Qs have out or underperformed gold by the number of percentage points on the y-axis. And I have two quick points on this chart. The first is that the NASDAQ 100, our proxy for human ingenuity, has outperformed gold overall since 2006. More specifically, the Qs have beaten gold by an average of 6 percentage points over any given one-year holding period over the last 2 decades. That's because innovation, that is tech and growth stocks in the Qs, creates incrementally more value than the usually more static demand for a store of value like gold. The second is that, as you can see in the chart, the annual relative returns between gold and the NASDAQ 100 have been quite choppy over the last 2 decades. So for example, the Q's one-year returns underperformed gold by an average of 11 points from 2006 to 2012, but outperformed by 15 points since 2013. The key takeaway from this chart is that investors are more likely to put a premium on human innovation when economic and market conditions are mostly calm, like in the 2010s bull market. On the flip side, gold often outperformed the Qs from 2006 to 2012, given the financial and Greek debt crises and Great Recession. The opposite has been true since 2013, with the exceptions of 2016, the back half of 2019, the first half of 2020, and 2022, when there were either recession concerns or an economic contraction. Connecting this history to the present, over the last 12 months through today's close, the Qs have underperformed gold by 27 points. That's a huge and highly unusual underperformance. In geeky terms, it's between 1 and 2 standard deviations below the long-run mean, even though there's not been a crisis yet. As for why, we have a few possible reasons. And the first is that gold is experiencing unusually high demand due to trade and geopolitical uncertainty. These tensions are currently making safe haven plays like gold more compelling than the value of human innovation. Gold is also an arguably surer bet if you believe non-US holders like foreign central banks will continue to be large buyers of the asset, which we think is safe to assume given recent history and rising geopolitical risks. The second is that the trajectory of human ingenuity from here is somewhat uncertain given questions around AI's development costs, its monetization, and Chinese open source competition. And we have one important caveat here, which is that the last 2 years have shown the Gen AI story can develop quickly, and we're only a few killer apps away from potentially making it as big as the internet. Now, Given that U.S. large cap growth stocks and gold have out or underperformed at different times, we also looked into whether there are diversification benefits to owning both. Here's a chart that shows the 1-year trailing correlations of daily returns between the NASDAQ 100 and gold back to 2006, again using the Qs and GLD. As a reminder, correlation measures how closely two variables relate to each other. A correlation of plus or minus 1 reflects a perfectly positive or negative linear relationship. A zero correlation says there's no linear relationship between the two variables and that they move independently of one another. And lastly, anything in between indicates some relationship, and the closer it gets to plus or minus 1, the tighter it is. So with that, the average 1-year correlation of daily returns between the Qs and gold is 0.04, which in statistical terms is an R-squared of 0%. That means that the Qs and gold trade independently of each other, and their movements are entirely based on their own fundamentals during any given year. In other words, there is diversification benefits to owning both assets. Even with their 1-year correlations of daily returns climbing since the start of 2004 to 0.2 through today's close, that's only an R-squared of 5%. So wrapping up, we think investors are best served owning both U.S. large cap growth stocks and gold. Human innovation delivers better long-term returns given its theoretically limitless potential and should therefore have a much larger portfolio allocation. Of course, this ingenuity needs to be channeled into profitable ideas, which is a bit uncertain right now, but that's the price investors pay for the optionality of their future payoffs. Gold still has a place as a hedge in portfolios because its history shows it outperforms when humans question the value of their own ingenuity, like now. Additionally, gold will always be scarce and valuable, and demand is currently strong. Lastly, I just want to fully disclose that I own the Qs and I'm a big fan, and my co-founder Nick Colas has an allocation to both physical and financial gold. With that, thank you very much for taking the time to watch this video. Please hit the like and subscribe buttons if you enjoyed it, and you can also sign up for a 2-week free trial on DataTrekResearch.com to receive our daily investment newsletter. Thanks again for watching, and we hope you have a great day.